This recording is looking at the autumn 2017 interim assessment question 2, focused particularly on consolidations. So have a look at the requirements firstly. We're asked three particular requirements. Calculate the closing group retained earnings, 6 marks, goodwill working, 4 marks, and then consolidated statement of financial position. Now remember, you're going to have to do A and B to do C anyway, so you may as well do them all together. However, remember, based on the layout, you will be given a solution workbook. So if we just look up maybe 22. So for question 2, they tell you the calculations. So they give you a layout for part A. So you have to show your working for retained earnings there. You have to show your working for goodwill there. And then part C, they'll leave you a template that you can start your consolidated statement of financial position. Just make sure you fit it into the required answer workbook as required. So we'll have a read down through. I assume you've read it through it already. I just want to highlight a couple of things that you should be spotting when you're reading through these questions. Year end is 31st December. You have one company and an investment here in Tarinas. So we'll figure out how much that investment is in a second. Nothing else unusual stands out. We have a revaluation reserve and we have €1 ordinary shares. So that makes it easy for calculating. And you're told they bought 75% stake. So that is important because that means you're going to have a 25% NCI, non-controlling interest. Then at the acquisition date, and we're told up at the top, which I overlooked, it's a mid-year acquisition. So it was bought on the 1st of July this year. That means it was 6 months post-acquisition. And we're told the position at the start, so then we can calculate our goodwill. Then you're told there was sales, and it's important to put down the direction from the subsidiary to the parent. So from the sub to the parent during the year, and we have to deal with that. And then there's also intergroup balances at the year end. So 4 and 5 are looking at together because they don't balance, and there's this issue of cash in transit. And really what note 6 tells you is the NCI is measured using what we call method 1, and there's no fair value adjustments. The fair value of net assets equals their book. So it's always important to read through the questions so you know exactly what's asked. We now have one subsidiary, a goodwill calculation, intergroup trading from the sub to the parent, and intercompany balances that have to be agreed. So what we're going to start off with, and my preference is when you're doing these questions, is to set up your final answer before you begin. Because as you finish with them, particularly here, 30 marks, that means you have about 27 minutes to do it. So you will be tight on time. Now, whatever way you like to set it up, my preference is to do parent plus subsidiary plus your adjustments columns. And that allows you really to, as you go through the workings, to slot them in, so you won't run out of time at the very end. Now, for shorter questions like this, it is also feasible just to do PPE and put in 4400 plus 1600 and not put in separate columns at all, and that will be fine. But for tutorial purposes, we'll do it the long way, just putting them two side by side, leaving an extra line for goodwill and leaving an extra line for our NCI, which are two specific items just for group accounts. And the first thing we're going to do then is do our goodwill working, which you have to do in a particular section for your answer booklet. But for here, we're just going to do it working 1, goodwill, and we're going to break it down. So how you get your goodwill is you firstly start off with your investment. Your investment here, let's bring it up a bit bigger. For goodwill, the investment is 1600. So we're assuming they were working in thousands. Your NCI, you don't know what it's going to be valued at yet, but you'll figure out in a second because it's going to be 25% of the net assets. And you take off the fair value of net assets at acquisition. So that's how we calculate goodwill, as we compare the investment plus the NCI, and the fair value net assets at acquisition, we're told in note 2, was 1 million. So therefore you're going to have 1 million there, and 25% of that will be 250. So that means our NCI at the date of acquisition, just bring these up to a bigger font. That means our goodwill at acquisition will be 1850 minus a million, which is 850. So your goodwill at the date of acquisition, which is your answer to part B, is 850. You're given all the equity section at the date of acquisition, so you don't have to do any adjustments. So your goodwill there is 850. So that answers your part B, which is actually for 4 marks, nice and short one. But my preference will be now, as you go through, you put in your adjustments. So don't leave it till the end, because you'll end up going back over the working again. The adjustments are here. If you want to know your debits and credits, it's going to be credit investment 1600 to remove it because you're cancelling it out. You're going to credit the NCI 250. So I'll just do these separately just so we can follow what the adjustments are. It's credit investment 1600. It is credit NCI 250. You're creating an NCI. Now be careful with your fair value net assets. You have to do each of them individually. So ordinary share capital, you're going to debit. You're going to debit share premium. You're going to debit reval reserve. And you're going to debit retained earnings. So we're saying each of those are pre-acquisition, they're always removed. So 300, 50, 50 and 600. And your balancing figure then is to debit goodwill 850. So both sides will tot to 1850. Now you're not asked for the debits and credits here, but in terms of translating it into a final statement of financial position, it's no harm to use it and slot them in as you go. So we're just going to slot all of those in as a starting point to show you how it can be very efficient to have this template set up, that as we go through it then, all we have to do really is slot them in. Property, plant and equipment, no adjustment. The investment here is going to be credited, so you're going to remove 1600. So you're minus 1600 you're adding across because that's a debit balance, and to credit it would reduce it. And your goodwill is going to be debited 850. So that means there we're going to increase it by 850. Inventory, no adjustment, nor any of those, so we go down. Our ordinary share capital, we're removing 300. i.e. you always remove all of the ordinary share capital of the sub, and you're debiting 50 for share premium, and you're debiting reval reserve 50. So that means all of these were pre-acquisition. They were there at the acquisition date. However, it's only 600 for retained earnings. So that suggests that since the date of acquisition, they've earned profits of 400,000, which we will have to deal with at the end of the question. And then we're crediting our NCI 250. So we're creating a new NCI and crediting 250. So it's no harm to know and bring them in as you do the workings. So it makes it very easy to finish off the question at the end. So that's our first adjustment done. Our next adjustment then we're going to look at is to deal with this intergroup trading. All right, so if we come down and we're saying the important thing here is to look at the direction. All right, so if we come to this, so this is our working 2, which is intergroup trading. And the first important thing is it's the sub that's selling to the parent. So it's important you get the direction right, because that means the unrealized profit is in subs accounts. And that means it will impact the NCI. So there's a number of ways of doing this, but I'll show you the way I do it with the debits and credits and layer it back into the columnar approach. So what we're saying here is there was the subsidiary sold goods to the parent of 500,000 post-acquisition at a profit margin of 50%. But only 80,000 were still on hand. And that's you're only interested in the inventory that's still there because that's the unrealized proportion. So the unrealized profit here will be 50% of the 80k. So that means your unrealized profit here, 80,000, will be 40. Because remember, we're dropping off the last 3 zeros. So your URP is 40. So you need to reduce subs profits by 40. Because the subs profits are overstated and the inventory is overvalued. That's the issue with unrealized profit. So you're going to debit group retained earnings and you're going to debit NCI. And finally then we will credit our inventory. So the logic is here, inventory is overstated, so you reduce it by 40, which is a credit. For the NCI and group retained earnings, The reason we're splitting it is we're reducing the sub's profits. So when you reduce the subsidiary's profits, you need to apportion that. The group retained earnings is getting 40 times 0.75, and the NCI is getting 40 times 0.25. Now there are other ways to do that, you'll see in the solution, and that's fine. The net impact is reducing the NCI by 10 and reducing group retained earnings by 30. So whatever way you want to present it, it's fine, as long as you remember who you're adjusting the profits for. You're adjusting the subsidiary's profits. But the nice thing about this then is once you have the adjustment done, slot it in and you move on. You credit the inventory. So if we come back here, crediting inventory means we're going to reduce inventory minus 40. So inventory should be 40 lower. And then we go to our group retained earnings and our NCI. Group retained earnings I would always leave as a separate working. Because you have to do it in part A, you can slot it in here as I've slotted for this one, but it might be better off to leave it as a separate working because you're going to have to do a number of adjustments together. But for the sake of it, you can leave it in as a reminder, but I'd usually open up a group retained earnings working and capture all of them there because you may not capture them all neatly here. And then your NCI, you're going to have a 250 plus, but you're also going to have a minus 10. I'll just put a there. So you have two adjustments now in your NCI. So sometimes people like to prefer to keep the NCI and retained earnings as a separate working completely, and that's fine as well, because you may not feel like it's neat enough in your columnar approach. The last working then is your intergroup balances. So working 3, which is your intergroup balances plus what we call CIT, cash in transit. So what we're saying at the year end is there's an intergroup balance. The parent owes the subsidiary 100, but the subsidiary says the parent owes them 170. So trade receivables are 170, yet the trade payables are only 100. Now the problem is we cannot cancel those out because they don't balance. So what we have a situation here is called, there's a difference of 70. And you're explained in working 4, that difference is cash in transit. That the parent has paid 70 at the year end, but it hasn't been recorded in the subsidiary. So step 1, bring in the cash in transit. So we're going to bring that into the subsidiary because they got paid. So debit bank and credit trade payable, trade receivables. 70 and 70. So you're bringing that in to the subsidiary's accounts to say, look, this cash was been paid to you at year end, you just haven't got it yet. So that means our new trade receivables now will be 170 minus 70. So both of them will now align to 100. So step 2 is cancel out balancing items, meaning debit trade payables 100 and credit trade receivables 100. So that's your 2 steps when you're dealing with cash in transit. Is first bring back in the cash in transit because it's kind of disappeared into a black hole, and then cancel out the balancing items. You have to remove them as well because you can't have intergroup balances between a parent and a subsidiary in a consolidated accounts. Just slot in those then to finish them as you go. Trade payables you're going to reduce by 100. Your debiting trade payables is a reduction. Just slot it in there in your column. Your trade receivables you're going to reduce by 170. So you did a 70 and 100. And in your cash you're going to increase by 70 for your adjustment. So you can start to see very quickly the benefit now of having this done is that we have a lot of our adjustments in. So finishing off the question will take a small bit of time, if anything. So that is all our workings complete, but we still know how to finish off consolidated retained earnings and finish off our NCI, etc. So if we come back over, we'll set up a new working for consolidated retained earnings. We'll call this working 4. Now I would always advise students to keep a separate working for group retained earnings. Don't try and do it in the column approach because you'll have too many adjustments. So our starting point, remember this is answer to part A for 6 marks, so you're probably better off to keep it separate anyway in the answer booklet. Your starting point for the group is always the parent retained earnings at year end, which in this question the parent's retained earnings is 4720. That's your starting point. We then had an adjustment from working 2, which was the unrealized profit. So the unrealized profit, your share, it was a debit retained earnings of 30. So that's a minus 30, i.e. 40 times 0.75. Now there is another way to bring it in, and that's fine. You can bring it in as part before you take the 75% and you take the net, you'll get the exact same answer. So either or is completely fine. And the other main thing you need to bring in for closing retained earnings is the post-acquisition profits from the sub. So in this case, the post-acquisition profits, it was $1 million at year end, but at acquisition it was 600. So they made 400,000 Tarinas from that 6-month period, and you will be entitled to 75%. So it's 400 times 0.75 is plus 300. Now some students will do it directly and you'll get an answer of 270. When you get to 75%, that's fine as well. Either way, presentation will be acceptable. So closing group retained earnings then is those three added together, which will be 4990. And that is the answer you're going to put in your consolidated SOFP. And that's what your 6 marks are going for your part A. So you have a nice template to understand what you go in there. I typically keep it as a separate working. And the way you'll present that then, if we go back to the template, will be when you go to retained earnings, don't worry about adding across it all now. I'll just put in a last figure, 4990. And I'll reference there C working 4, or in your workbook you'll be looking at part A. So it's nice to cross-reference where the workings are coming from. Now technically we took off this 600 because it's already taken off there. So it's nice to just put it in so you know the debits and credits are going in correctly, but we already have accounted for it here as well. So don't get too confused about where it's coming from. The other main adjustment we always make, or working you have to do at the end, will be working 5. What's the closing NCI? W5, which is non-controlling interest. Now some students prefer to do the columnar. Again, my preference would be to do it in nice separate working. The value in acquisition, which is working 1, was 250. So you said at the 1st of July, the value in the NCI was 250. We did have an adjustment from working 2, which was your URP, because the subsidiary was selling it. So there was a minus 10 there, which was 40 times 0.25. So notice the adjustments here and here. And likewise, very similar structure to the working 4, they are also entitled to post-acquisition profits. So of the 400, the group is entitled to 75% because that's what they own. The subsidiary is entitled to the other 25%. So they get 100. So your NCI at the year end will be a net figure of 340. And that will be in the consolidated statement of financial position. So you might have done it just net and you got 90 there, that's fine. But your final answer has to be the same, 340. That's your closing non-controlling interest. The goodwill working is the starting point, then take off your adjustments and bring on your post-acquisition profit. We did not have any post-acquisition revaluation reserve because the closing one was the same as the date of acquisition. If you did, you'd have to allocate that between the parent and the NCI as well, but we didn't have it here. So likewise, just in case you're wondering, the 250 and the minus 10, you could have done it that way as well. We just laid it out slightly differently. So they're completely fine. You don't need to add across, but either way is acceptable. So if you just added in the other 100 there as an adjustment and added them across, that'll get full marks as well. Whatever presentation suits you. So your final answer there is 340, and we reference there working 5, so that we can show the examiner exactly where the figures are coming from. And they're always the 2 last workings you do before you finish off your financial statements. You do your closing retained earnings and your closing NCI. And now it's a matter of, because we have the question set up, it's just simply adding across, which is your part C for the closing statement of financial position, which is worth 20 marks. So remember, you'll ideally have this template set up so it's a very quick finish at the end. It might take an extra minute or two to start the question, but you'll gain that back at the end. This is just parent plus sub, no adjustments needed. This is nil. The investment is always wiped out when you're doing a goodwill calculation. That's always cancelled against the net assets. And then our NCI is 850. Or sorry, goodwill should I say is 850. So our total non-current assets are 6850. Our inventories, parent plus sub, plus our adjustment for unrealized profit is 960. And a good student for these adjustments might put a little biro where the working is coming from. That adjustment is working 2. These adjustments are working 1. Just in case there's any confusion with the examiner where figures are coming from. Trade receivables then, you have a 20 plus a 300 minus the 170, which is coming from working 3, to show the examiner where it's coming from. And then you have your cash plus your cash in transit from your working 4. So all kind of neatly slotted in as we go. So the finishing off of the question should be the easiest part, if you have it set up correctly. So that means the total assets are current and non-current, which are 9030. When we get to our equity, we will never, for ordinary share capital and share premium, you never have any of the subsidiary. That's what the adjustments are, because they always go to your goodwill calculation. So it's just $1 million here left, and 400 for the parent share premium. Revaluation reserve, there's no post-acquisition, it's all removed, so it's just the parent's 200. So that will leave us then with 6590 before we add on our non-controlling interest, which we've done already as a separate working. And you tot up them, and that will get you 6930 total equity. So it's nice and structured if you put up the groundwork to set up your template at the start. It's very beneficial. You want to avoid going back over the question too much or back over the workings. You won't have time in the exam. And then your current liabilities, trade payables only, parent plus your subsidiary minus your adjustment for intergroup, which is working 4, or working 3 should I say. So that's 2,100. So when we add those up, your equity and liabilities, thankfully, will match your total assets, and you know you're correct. So that's your part C, the finished statement of financial position, which gets you 20 marks. So I said, don't try and do A, B sequentially. Try and make sure you focus on the overall question. When you're doing a consolidated statement of financial position, as is asked for here, you're going to be doing part A and B anyway. So take them in order that you would normally take them, and don't get overly confused about it. So you had about 27 minutes, 90 minutes times 30% of your marks to do that question. And the big approach, my preference would be set up a template up front. You don't even have to put in the parent and sub figures, but at least have the line items there that every time you do an adjustment, you can slot it in. Because what typically happens with students is they'll do the adjustments, they won't put them anywhere, and then they'll end up forgetting them. So that means you'll lose marks for your 20 marker when you forget to follow those adjustments through to the financial statements. So that was Autumn 2017 paper, question 2, looking at group accounting.